Hey guys, how's it going? I just want to talk today about a very popular stock that just reported earnings, ticker symbol SNOW, Snowflake. And as you guys know, this stock has taken a huge beating since the beginning of this year. I mean, since January, it's down like almost 40%. And if you go back to 2021, it's down like 70%. So it's been absolutely destructive to long-term shareholders. Unless you've been trading it here and there, it's been really destructive. And the business has just not been doing too well in terms of returning shareholder yield. But basically, Snowflake, what Snowflake is that they provide like an elastic, scalable cloud data warehouse. So they have this cloud data warehouse. They can store and analyze all the data records in one spot. You can use this. There's a bunch of APIs you can use. And, this can run on virtually basically multiple different workloads, and you can have tons of users. You can have a bunch of different, pipelines, and they're really utilizing, the whole AI thing with, decoupling storage and service infrastructure so that different platforms can really deliver optimal sets of data effectively. So if we take a look at their earnings, earnings just from a first look looks really good, right? I mean, revenue you beat by 2.7%, by 2%. They're beating their guide by 2.7. RPO, they missed billing estimates by 7%. They beat their EBIT by 27 million versus 17. EPS, they beat that by 3 cents. So pretty good stuff altogether if you consider what the street was expecting. And if you take a look at some of their customers, they have these huge customers like Canva, JetBlue, Disney, Honeywell, NYSC, or Pfizer. Like, they just got tons of different really, really big customers. And that's really what's been fueling their huge growth. If you take a look at, just some numbers from their earnings report, you see that earnings 30% year over year, absolutely amazing. Retention rate is over 100%. It's very good. That means people are, liking the service at least somewhat. 512 customers, with the revenues of greater than 1 million. And as you know, these services are super expensive. So it's not like you can have some small startup just, spending all their cash on this type of network infrastructure. They really need to have a good use case for it, and they need to see the return on investment. So just going over all of that, product revenue 30% year over year, margins 72% year over year, and free cash flow is also improving. But I'm going to tell you there's some caveats later. Third quarter guiding for 20%-ish growth, and full year around 25%. That's good. I mean, clearly this business is really, really good. There's no doubt about it. But we just need to see now whether we can pay the price. I talked about before, but the price now $116. So you're talking a little under a $40 billion market cap. Okay, so if we take a look at some of their things about how they're if you take a look at that, I mean, 38% last time. People are estimating it's going to be around 30% and then slow down to 20% in the next coming years. But you can see they're doing 30% growth, which is absolutely incredible. You look at their customer commitments, it's also growing. If you look at the first quarter and second quarter, absolutely amazing stuff. I mean, there's nothing really wrong here. Total amount of customers, 8,500 to 10,000 in the span of a year. I mean, that's crazy with all these huge companies as well. I mean, you can't really go wrong. You can't really say anything bad about this business as a business. It's just absolutely amazing, I think. Okay, now we're going to go to the actual balance sheet itself. Revenue up, that's in the 20s. If you take a look at the net loss, they're still not profitable, which is kind of going to be my biggest gripe going forward with this business. I like seeing that gradual positive, getting towards positive eventually. But that's kind of my gripe with this, and I'll also tell you about the stock-based compensation and their free cash flow in a bit. But you can see their actual, products are very profitable. It's just the fact that, once you get that 580 million over here, and then you deduct the R&D and the sales, this type of data storage is super expensive, and you wouldn't think that at first glance. So that's basically what's going on in terms of their profitability. Earnings per share, if you're including the shares attributable, it's negative, but it's actually positive if you kind of exclude that part, which I don't think you should, and I'll go over that later. But in terms of balance sheet, really good balance sheet, nothing wrong over here. They have a good cash position, nothing crazy with the debt, and all of that deferred revenue, it's going to go into the assets later. So current liabilities are less than the current assets. So, in terms of balance sheet, very strong. They can take on more debt if they want to. Nothing wrong with this. Very good, very good. And if you look at from the cash flow statements, you can see that they're losing money. If you look last year, they lost even more money from last year. But that's because of this thing that I absolutely hate, and it seems like every tech company is doing it now. but Snowflake just does it to another level. One of the reasons why I was kind of shitting on Palantir, even though Palantir is a great company, but I think Palantir is priced way more appropriately than Snowflake, is that, you know, there's just crazy amounts of stock-based compensation. And the main argument against that is like, well, you need to offer your employees good stock-based compensation. I mean, come on, $356 million a quarter, and the amount of employees that they have as a percentage of free cash flow, I think it's absolutely ridiculous. Like, there's no excuse for this. This is just too much. If anything, they should have raised capital when the stock was $200-300, which they did in 2020 when the stock price was absolutely unjustifiable. So they should have had a share offering and raised cash. If you want to give cash bonuses to really get employees, I mean, that's a different story. But I mean, $356 million in 3 months, unacceptable in my opinion. Yeah, so like I was saying, you know, we're gonna have a net loss, and I don't know when necessarily this is gonna close the gap, but you know, we'll see what happens. Another thing I don't like, and I can show you about a little bit over here, is that they did say that they have the authorized to repurchase the $2.5 billion until 2027. I don't know how much of that they're actually going to do right now, and I think they have already purchased some stock, you know, like in high 100s. But in my opinion, and I'm going to go into the valuation a little bit later, the stock is still so overpriced that it would be a waste of this cash at the current price, I think. Given that their metrics don't improve really fast, I think this $2.5 billion should not be used to repurchase stock, and they're giving so much stock away. So it's kind of like you give with one hand and then you take with the other. But in terms of the revenue, all the way until 2027, they're predicted to have $5 billion of revenue. So we're talking, you know, basically 20-ish to mid 20% growth all the way to 2027, which is really incredible. I mean, their business is solid. They're retaining customers like crazy, so you can't really hate on that. And here is where my qualms come. Okay, so we saw the positive, I think, 0.16 EPS. Well, that's not including, you know, that's like non-GAAP versus GAAP. So that's not including this stock-based compensation. That's absolutely atrocious, you know. So, you know, your GAAP EPS -2, it's supposed to go down even more next year. And then if let's just include the attributable shares, it's going to be $1.40 basically in 2027. That's what analysts have been predicting. They've been slightly beating, so I'm going to give them benefit of doubt and say there's like a 20-30% gain, which is not conservative, but we're going to go into that a little bit later. So I'm going to make the assumption that in 2027, let's say they hit like $1.7 per EPS per share. We could even go as high as 2. Let's say they just blow out of the water, right? Possible. So that's the assumption that I'm going to have later. But let's just talk about the free cash flow first. So this year they're going to have around like $800 million in free cash flow. And we just saw that in 3 months they gave $350 million of stock-based compensation. I mean, if you analyze that like $300 million, if you annualize that $300 million of stock-based compensation, I mean, that's over $1 billion in stock-based compensation. So, yeah, so half the year, 687 times that by 2, 1.2 billion, do a free cash flow. You know, that's 40% or more than the free cash flow you're going to do next year. Really bad stuff, guys. And, you know, you can argue that a lot of other companies like HIMS and all that, they also have higher free cash flows. But the difference is that, you know, they just became profitable. And Snowflake's, it's been a while since they've been increasing their revenue. By now, they should have really been able to dial down their free cash flow and the amount of shares that they're giving out. But I'll give them the benefit of the doubt and say that, you know, if they're able to grow their free cash flow at this like crazy of a pace, like 800 million to 1.1, that's like 20 to 30% increase. If they're able to do 20 to 30% increases, and if they don't even get any more crazy than they currently are, you can make the argument that like, okay, let's just leave it where it's at. In like 10 years down the line, you could have like maybe $6-7 billion of free cash flow per year. And in that case, you know, everything starts to make a little more sense. But there's just too much speculation, and that's 10 years of 30% free cash flow growth. So just bad stuff, I think. Shares outstanding, really crazy since COVID, somewhat stabilizing. So that's good. Now, in terms of a forward PE metric, right? So if we say that in 2027, their earnings per share is going to be 1.7 normalized, so we're including all those shares in stock-based compensation. At a current price, we're looking at like a 68 times forward earnings in 2027. I mean, for a company that's growing, let's say 25 to 30%, has not really great has really pretty bad net income margin so far, right? Bad net income margin, but they're probably going to really improve that rapidly. but they haven't figured out a way to make that profitable, given that they have to put that R&D expense, the marketing expense, all those expenses. Even though they're making good money off their data storage, they still haven't found a way to make it profitable. So I mean, if margins get a lot better, let's say, and we still grow 25 to 30%, like 2-3 years from now, we're trading at a forward PE in the 60s. So I mean, to me, that's crazy. This stock needs to really be, I mean, I wouldn't even really consider this stock unless it was like under maybe $70 or something. I mean, it's just crazy to me. This is not a good buy in my opinion, and I don't even think you need to delve too much into the company unless you believe it can just grow that fast. And I think if you think it can, and I think this company can grow really fast, there's just way too much speculation involved at the current price. Something like Nvidia trading at like 30 times forward earnings makes a lot more sense than this, I think. I mean, you've already seen their backlog, the Blackwell stuff, and their earnings per share growth has been absolutely insane. I mean, but something like Snowflake with like 60 times earnings, I mean, not profitable after their expenses, net income margins not good, and I can't see it getting that much better in the next 1 or 2 years. I really just can't buy this unless the price goes down in like half, even from here. So I mean, the end of my gist is I don't think this is a buy. I think this has a lot more room to go down. I don't know if it's going to go down, but I would not buy this stock right here. I think it's an amazing business, but a terrible stock.